All right, let's get right into it. Today we are taking a fascinating journey straight through the heart of the stock market in this explainer. We're going to completely strip away the confusing jargon, ignore all those flashing red and green lights, and really uncover what's going on behind the scenes. We'll be moving from the chaotic, super high-stress world of day trading right down to the rock-solid principles of long-term wealth building. So whether you're completely new to this or you're just looking to sharpen your perspective, we're going to break down both the mechanics and the psychology of the market.
Okay, let's dive into this. Picture this for a second. Waking up, getting totally zooted on caffeine, sitting down at your computer, and risking 60 grand on one single, highly volatile tech stock in a matter of literally seconds. That's exactly what one day trader in our source material did to demonstrate how this market operates. It sounds incredibly stressful, right? You've probably seen influencers all over social media bragging about buying luxury cars with their stock market money, making the whole thing look like an absolute breeze. But behind all that hype, the reality of day trading is an entirely different beast.
And here is that harsh statistical reality. The math is just brutal, guys. A staggering 97% of day traders outright lose money. Another 2% might see a profit, but they kind of bounce around and can't do it consistently. That leaves a microscopic 1% of day traders who are actually consistently profitable. If you want to survive out there, let alone thrive, you absolutely have to understand how that 1% operates, because here's the secret. They're essentially doing the exact opposite of the panicking 99%.
So, to help us wrap our heads around how the market actually works, here's our roadmap for today. The game of chance, speaking the market's language, reading the charts, the institutional game, and finally, the psychology of money.
Let's kick things off with Section 1, the game of chance. Short-term trading really isn't just about the math. It's a high-stakes psychological battlefield.
I absolutely love this quote from the source material. Day trading is basically a game of patient people taking money from impatient people. It hits the nail on the head. The top 1% of traders survive because they completely avoid emotional impulses, while the 99% of retail traders are out there reacting to every little price jump or drop, panic selling or fear buying. The 1% are just calmly executing a strategy. They know exactly what they're waiting for, and they literally just sit back and let the impatient traders hand their money right over to them.
Now, you might be thinking, well, okay then, I just won't participate at all. Problem solved. But avoiding the market entirely isn't the answer either. Studies actually show that the average American loses roughly $18,000 over a 12-year period simply due to a lack of financial literacy. That's literally the price of a decent used car just left sitting on the table, all because the financial industry makes things seem way too complicated for regular folks. We really do need to participate, but we've got to do it smartly.
Let's move to and see how this builds in Section 2, speaking the market's language. Because, hey, to play the game, you've got to know the words.
We hear the word stock tossed around all the time, right? But at its most basic, fundamental level, a stock is simply a unit of ownership in a business. When you buy a share of Apple, you are literally buying a tiny fractional piece of that entire company. You have equity. It's not just some blinking ticker symbol in a giant digital casino. It represents real, tangible assets, real products, and real earnings.
Now, here is where a lot of beginners get totally tripped up. Imagine Company A has a stock price of $100, and Company B's stock is $10. Is Company B a better deal? Not necessarily. The share price all by itself tells you absolutely nothing. You have to look at market capitalization, or market cap for short. You calculate this by taking the share price and multiplying it by the total number of outstanding shares. This reveals the true total value of the company according to the overall market. So that $10 stock could actually belong to a massively overvalued company, while the $100 stock might actually be an incredible bargain.
Once you understand what a stock actually is, it forces a massive psychological shift. It's the core difference between investing and trading. Investing is very much a long-term mindset. You're taking ownership in a business, fully believing it's going to be worth more in 5, 10, or even 20 years. Trading, on the other hand, is short-term. You're trying to grab a profit from quick price movements over just days or weeks. So essentially, trading is trying to predict human psychology and perfectly time the market, while investing is simply betting on the long-term future value of a real living business.
All right, shifting gears into Section 3, reading the charts. If you decide you do want to analyze these price movements, you really need to understand the visual language of the market.
The absolute foundation of technical analysis is the candlesticks chart.
Each one of these little candlesticks represents a specific chunk of time. Maybe it's 5 minutes, maybe it's a whole day. But it shows you 4 crucial things: the open price, the high, the low, and the closing price for that specific period. The thick part in the middle is the body, and those little lines on the top and bottom are called the wicks. Simply put, a green candlestick means the price closed higher than it opened. A red one means it closed lower. It's basically a quick, visual summary of the tug-of-war between buyers and sellers.
And this brilliantly illustrates how we identify market trends without just, guessing. We look for objective measurements. An uptrend is when a chart is consistently making higher highs and higher lows. Think of it like walking up a staircase. A downtrend is the exact opposite, consistently making lower highs and lower lows. Identifying this trend is hands down the most objective way to know which direction the market's momentum is actually flowing, so you can make sure you're trading alongside it and definitely not against it. To help spot these trends and find those sweet spots of value, traders use indicators like moving averages. This is really just the average price of a stock over a certain number of past candles. The 20-period, the 50-period, and the 200-period moving averages are incredibly common. But why do they actually matter? Well, it's because millions of traders around the globe are looking at these exact same lines. Because everyone is watching them, they often act as vital areas of support, meaning where a falling price might suddenly bounce back up, or resistance, which is where a rising price might hit an invisible ceiling. It's almost like a self-fulfilling prophecy.
Okay, let's step up to the big leagues. Section 4, the institutional game. We're going to pull back the curtain right now and look at how the real heavyweights operate.
You remember that 1% of successful day traders we talked about earlier? Well, they trade totally differently because they follow the institutions. We're talking the billion-dollar hedge funds and the massive banks. Now, these giant funds have a unique problem. Their orders are so incredibly huge that there often aren't enough sellers at the price they actually want. So what do? They engineer what's called a liquidity grab. First, they might sell some shares just to artificially drive the price down right past a key support level. Everyday retail traders see this drop, they totally panic, and their automatic stop-loss orders trigger, which means they start selling. Boom, now there's a massive flood of sellers. The institutions swoop right in, buy up those massive blocks of shares at a total discount, and the price shoots right back up. They literally manufactured the panic they needed to fill their own orders. Wild, right?
So, the absolutely crucial point here is understanding liquidity. Liquidity is simply the availability of buyers and sellers at any given moment. Highly liquid markets mean you can easily convert an asset to cash without severely moving the price. Finding exactly where this manufactured liquidity sits, where all those panicked sellers are hiding, is the mechanical secret behind massive, institutional-level day trades. It is exactly how the big money operates.
Which brings us to our final stop, Section 5, the psychology of money. Because honestly, all the technical chart reading and institutional knowledge in the world means absolutely nothing if you don't have emotional control.
Author Morgan Housel gives us a truly brilliant way to frame market volatility. He says you should view it as a fee, not a fine. Think about it. When you get a parking ticket, that's a fine. You did something wrong and you're being penalized for it. But when you go to an amusement park, you gladly pay an entrance fee to get on the ride. Seeing your portfolio drop 20% in a bad market? That's not a fine. It's simply the emotional fee required to participate in long-term wealth generation. If you can't stomach paying that fee, you're just not going to get the returns.
Now, what's really interesting about this slide is how our actual brains are wired. If I come up to you and say, the market is going to crash tomorrow because of inflation and global debt, you are going to listen really closely. Pessimism completely triggers our evolutionary survival instincts. It sounds super urgent and highly intelligent. But if I tell you things will just slowly get better over the next decade due to human innovation, well, that kind of sounds naive. We are biologically hardwired to panic and listen to the doomsayers, and sadly, acting on that panic is exactly what ruins most investments.
And the proof of this is right here in this Dalbar study of 20-year annualized returns. While the overall market, represented by the S&P 500, returned an average of 7.2% per year, the average individual equity investor only earned 5.5%. Why the gap? Because they let their psychology manage them. They panic sold during downturns when the pessimists were shouting the loudest, and then they turned around and chased hot, hyped-up stocks just out of pure fear of missing out. Their behavior literally cost them massive amounts of compounding wealth.
Which brings us to the incredible story of Ronald Read. Ronald was a janitor. He didn't have some fancy Harvard degree, he definitely didn't work on Wall Street, and no, he didn't win the lottery. Yet when he passed away, he had quietly amassed an $8 million fortune. How on earth did he do it? He simply saved consistently throughout his entire life, bought solid, reliable businesses, and let the magic of compounding do its heavy lifting over decades. He proved without a doubt that in the stock market, your behavior and your emotional control are infinitely more important than raw intelligence.
So, as we wrap up this explainer today, I really want to leave you with this final provocative thought to ponder. Are you managing your investments, or is your psychology managing you? Whether you ultimately decide to be an active day trader poring over charts or a long-term investor just holding for decades, mastering your own mind is the ultimate key to mastering the market. Thanks for diving into all this with me, and keep learning.